we're looking at income tax and Medicare levy. So our taxable income and allowable tax deductions, with those, anyone who earns an income has to pay that income tax to the government. So taxes are unavoidable. The government uses this money to fund our schools, hospitals, roads, anything that they might need to help to renew or complete in the first place. But not all of your income needs to be taxed, and that's why we have tax brackets. So we then have our allowable tax deductions, which are not taxed. So things like if you need to buy something to set up a home office, or if you donate to a charity, these are what we call our non-taxable items, and we can claim these back at tax time. So some examples here are work-related expenses, donations to charities, and home office equipment. When we calculate our taxable income, we use this formula. So we have our taxable income, which is our gross income minus any allowable tax deductions. So if we have here, your income tax is calculated on your taxable income, and we round it to the nearest dollar for the financial year of the 1st of July to the 30th of June the following year. And this is the same every year. So this is a tax table. This might not be the exact one for this current year, but it is a tax table that has been used in the past. And what we look here is that if you earn up to $18,200, you don't pay any tax. So this is what we call our tax-free threshold. Tax-free threshold. Or it can just be a TFT, tax-free threshold. So make sure you do know that term. What it then means is then anything over $18,200, we're paying 19 cents for every dollar. And that is up until we get to 37,000. After 37,000 up to 87,000, we pay this initial sum, which is that 19 cents per dollar for this amount, plus then 32.5 cents for every dollar. So each tax bracket you jump up, the amount per dollar does increase. And this first amount is the amount that you would have paid on the bracket beforehand, and so on. We then also have a Medicare levy, and it's another tax that we use to help fund our public health system. So if you have a Medicare card or your parents have a Medicare card, this is where we get the funds to be able to use those resources. So our Medicare levy is 2% of the taxable income. Although, as it says here, low income earners may pay less or no levy at all. That's all dependent on your circumstances. So we look at our example, which says Fraser earned $78,245 and claimed $467.80 in work-related expenses, $129 for the depreciation of his home computer. Calculate the amount of income tax and Medicare levy that Fraser should pay. So the first thing we need to work out is his taxable income. And if we look at our example or our formula from above, it says our taxable income is our gross income minus any deductions. So when an accountant does our tax, they look at what our taxable income is by saying what is your salary or what did you earn this year? And then if you have any deductions, they take them all off before they do those calculations, because what might happen is if you were in this larger bracket with those tax deductions, it might bring you down. Doesn't always happen, but it can help, which means it's better off for you. So this is our gross income minus any deductions. Our gross income is $78,245, and we have deductions, so work-related expenses. We have $467.80, and then the depreciation of his home computer, so obviously working from home for that one. That gives us a taxable income of $77,648.20. What we then have to calculate on that is our Medicare levy. Now, if we think back, it says up a little bit that our Medicare levy is 2%. So 2% as a decimal is 0.02. So I need 0.02 of my taxable income. And that tells me that I'd be paying $1,552.96 in Medicare levies. So therefore, calculate the amount of income tax that he should pay. So our tax is, if we look at the bracket that he is in, which is our 77,000, we look to see where does 77,000 fit. So that's going to be into this bracket here. So it's $3,572, which accounts for the tax in this second bracket, plus 32.5 cents for every dollar over 37,000. So we take our $3,572, because that is, we have to pay that. And then if we've got 32.5% or 32.5%, that is 0.325 as a decimal. So plus 0.325 multiplied by, and to work out what the difference is, we take what our taxable income is, and again we round it to the nearest whole number, and we minus what that low bracket is. So that would have been 37,000, because it's every dollar above 37,000 that we're paying this 32.5% on, or 32.5 cents. So if we calculate all that, that tells us that we need to pay $16,782.60 in taxes. Okay, and then we also have to add on that Medicare levy. So you've got Medicare levy of $1,500 and tax of $16,700.